that's all that's going on with that. But talking about automotives and whatnot and the rate cuts. So let's say they do a rate cut in September. It looks like they will. My guess is they'll do a quarter of a percent, so 25 basis points. They could go as high as 50, but I doubt they will. That might be a little too much of a shock. But that means that if they do rate cuts, you'll see some rate cuts on things like credit cards, interest rates. You'll start to see rate cuts on home loans, personal loans, things like that, and auto loans. So I wanted to jump into that real quick.
Fed Chair Jerome Powell says a September rate cut is on the table if inflation data continues to show signs of slowing. A change in the federal funds rate will have a number of effects on Americans' wallet. One of them could be your auto payments. Here with more, let's bring in Aaron Keating, who is the Cox Automotive Executive Analyst. Great to have you here with us, Aaron, and thanks so much for taking the time. So first and foremost, how does the federal funds rate affect auto loans?
Well, of course, when the interest rates drop there, we would see a drop in auto loan rates. We don't suspect that they will actually drop them as much as perhaps like credit card rates and things like that. But every consumer out there is battling affordability right now. So if the interest rates are going to come down, it's going to impact everything else in their portfolio of what they're managing for their money. And again, as our chief economist yesterday was speaking to in reaction to Federal Chairman Powell, it was saying that, our credit card rates might decline quickly, which might free up cash. The auto rates might not free up as quickly, but the cash.
So this is interesting. One, they're talking about auto rates, which is, she's right. It'll take them a while for auto rates to catch up. Usually about a quarter. Right, but what will happen almost immediately is the interest rates on credit cards will go down, which means you can make lower payments, or you can keep continuing making higher payments and pay it off, which is what we always recommend. You should always not have a balance on your credit cards.
Right, get rid of that.
Yeah, because that interest will slowly drain your finances. But if you could do that, like you said, it'll free up more cash for all of us as consumers, right? If we don't have to pay credit. Or people that have credit debt, at least, can pay less or get paid off sooner. So that'll free up a lot in the market going forward. So this whole thing about recession that they were talking about, or Kudlow was talking about, I don't really see it, because if you do cut the rates a little bit, you're going to see a little bit more cash freed up in the system. Right? So, but it could be a good thing to think about. Like we've talked about it before. If you've been sort of in the market to buy a home or a car or something, we were like, maybe you should wait. Or if you buy a house, you should plan that it's going to be really expensive for at least a year or so until the rates come down, and then you need to refinance and make sure you can refinance. But now's the time to start thinking about it as it's potentially going to happen here in the next few months. I think it's a good place to start. But yeah, I thought that was a great, just for the little bit she had there that we watched, she kind of nailed it home right away, which is the first thing is credit card interest rates are going to come down a little bit right out of the gate.
Listen, I gotta say, but eventually people wanting to buy cars and houses will be happy campers, because it'll start to float back down there. It'll make it to them too,
Yeah, because right now just home loan rates are 6-7%, which is really high for a home loan. And when you talk about the length of a loan, if you're 15 or 30-year loan, you're talking about, even on a $300,000 house, you're talking about $600,000 or $700,000 more you'd be paying just in interest.
Right.
Over that time period. So you're talking about
not insignificant.
Yeah,
it's a good chunk of money.
It's a huge chunk of money. So these are good things. And like with a car payment, if you need to get a car or you want a new car or whatnot, great for the market to buy a new car and everything. But the thing about it is, right now, if your car loan payment is 5% or 6%, that's really high, and it's hard to refinance your auto loans sometimes. Sometimes you can pretty easily, but sometimes it's really difficult. But like if you could now get a car and it was back to what it was 2-3 years ago, where it was like, zero down for the zero APR for the first year, and then it's like 3% or 2.5%. That's a pretty reasonable loan for a 6-7 year loan. which most car loans are. So it's like now we're back in a situation where it's a little bit more affordable than it was before. So yeah, so good news. Hopefully that they do the rate cut. I'm guessing they will. But yeah,
I hope so. I hope so because this will be good for consumers for sure. You know, we've been talking and we've been a little surprised that it hasn't happened yet. At least
yeah.
not, you know, a little.
Yeah, you'd think they'd come back a little. I don't even have an issue with them sticking it at like, if they want to leave it at like 4.5 or between there and 5, that's fine provided the economy is doing really well. I mean, they did that all through the 90s where it was around 4.755 to 5.25.
Mm-hmm.
But you also had the dot-com era, so everybody was making money hand over fist. So it really wasn't a big issue. But you can keep interest rates high like that and have a great economy. And you might think about doing that just to keep it from getting too hot to where, you know, it's a giant bubble and it explodes, right? But, you know, right now we don't really have anything like that. I mean, unless the AI revolution kicks in all of a sudden, then it might make sense. But we'll see. We'll see how it all plays out.